Welcome back to Talk Tickers. This is the show where we strip away the fluff, ignore the corporate PR spin, and get straight to the numbers that actually move your portfolio.
And if you're holding Calix today, you might want to pour a strong coffee.
Or maybe something stronger, yeah.
Yeah.
Seriously, this is what we call a textbook bitten down scenario. Calix just posted, its best performance in company history. We're talking record revenue, record margins.
Record free cash flow, all of it. And yet the market took one look at the guidance and just threw the stock off a cliff.
How bad was it?
Shares gapped down about 14% at the open, on heavy volume too.
It is brutal out there. So our mission today is simple. We are going to unpack why Wall Street hates the Q1 guidance despite, the record-breaking rearview mirror.
And we need to dig into this agentic AI pivot that management seems to be betting the farm on.
Right, and analyze the temporary costs that are dragging the stock down right now. It's a fascinating setup because the fundamentals, they look bulletproof.
But the narrative has hit a major speed bump.
Okay, so let's start with the snapshot. If you just looked at the Q4 numbers in a vacuum, without the stock price, you'd think this company was, ripping to new highs.
Exactly. Let's just run the tape on the headline numbers. Revenue came in at $272.4 million.
And that's up, what, year over year?
That is up 32% year over year. And it beat consensus estimates by about $5 million. It's their sixth consecutive quarter of revenue growth.
That's substantial growth. For a company in the broadband space. And the bottom line...
Solid. Non-GAAP EPS landed at 39 cents. Beat the street by a penny.
Okay.
But the real story for me, and the thing that usually drives valuation here, was the margin expansion. Non-GAAP gross margin hit a record 58%.
Wow.
That's up 250 basis points year over year.
Let's pause on that. 250 basis points, that's huge. That is 2.5% of pure profit added right to the top of the stack.
It implies significant pricing power. They aren't just, discounting the hardware to move it. They are selling value.
And that flows right down to the cash.
Absolutely. They generated record free cash flow of $40.3 million in the quarter.
And there's one more metric that growth investors usually drool over, right?
RPO, remaining performance obligations.
The backlog?
Basically, yeah. The backlog of contracts, signed but not yet billed, it hit a record $385 million.
Yeah.
Up 18% year over year.
So let me get this straight. Revenue beat, earnings beat, record margins, record backlog, record cash flow. And the stock opens down 14%. What is going on?
It is all about the guidance. It's always about the guidance. Management described demand visibility as being at an all-time high, but the market isn't looking at demand.
They're looking somewhere else.
The market is fixated on a very specific short-term margin compression coming in Q1.
Okay, let's unpack this because this is the core conflict, right? You have the CEO, Michael Weening, calling this the best performance in company history, and the market is saying, yeah, but we don't like what happens next month.
Exactly.
What is in that Q1 guidance that scared everyone so badly?
It's the margins. The revenue guide is actually $275 to $281 million. That's about 2% sequential growth. No big deal there.
Okay.
But the gross margin guide dropped. They are forecasting non-GAAP gross margins to fall to between 56.25% and 58.25%.
So at the midpoint, that's a drop of what, 75 basis points from the record they just set?
Exactly. And look, 75 basis points doesn't sound like a catastrophe.
No, it doesn't.
But in a world run by algorithms, they trade on margin trajectory. When you have a company that's delivered 8 straight quarters of margin expansion and then suddenly they guide down, the algos sell first and ask questions later.
They just see the trend line break and they hit the exit button.
That's it. But there's a reason for this drop, right? It's not like their business model suddenly broke.
No, and this is the critical nuance. It's what management is calling dual cloud costs.
Dual cloud cost. Okay, that sounds like they're paying double rent.
Yeah.
That is exactly what they're doing. Calix just launched their third generation platform in December, and they are migrating their entire software backend from AWS Amazon Web Services over to Google Cloud.
That's a huge undertaking.
It's massive.
Right.
And you can't just flip a switch and move 1,200 broadband carriers overnight. So for now, they're running the old environment and the new environment simultaneously.
So they're literally paying Amazon and Google at the same time.
Precisely. It creates this temporary cost friction. Management was very clear that this overlap drags down software margins for a bit. They say it ends in the first half of 2026, but for Q1, it's a real headwind.
And the market, being the short-term creature that it is, hates that. It hates paying for the same thing twice, even if it's for a good reason.
Right. And to be fair, they are moving fast. They've already migrated over 300 customers. The plan is to finish all existing customers by the end of Q1.
So this really should be a 1 or 2 quarter issue.
It should be.
Okay, let's pivot to the why. Why go through all this pain? The migration, the stock sell-off, it has to be connected to this new buzzword they kept dropping, agentic AI.
This is the big strategic shift. They aren't just moving to Google for, slightly cheaper hosting. They are partnering with Google Cloud to launch something called Agent Workforce Cloud.
Okay, agentic AI. I feel like every single earnings call I listen to now, somebody says AI 50 times. Is this just marketing fluff, or is there real tech here?
I think there's a legitimate technical distinction here. Most of what we see in the headlines is generative AI, right? LLMs that write an email or summarize a document.
Right.
Agentic implies agency. It means software agents that perform entire workflows all on their own.
The CEO used a construction analogy on the call.
He did. He said, think of the platform migration like building a house. The plumbing is done, the walls are up, that's the move to Google. Now they're bringing in the agents to actually do the work inside the house.
Give me a concrete use case. How does a broadband provider actually use one of these agents?
Okay, the best example they gave was marketing automation. Historically, a small rural telco, they don't have a data science team.
Of course not.
So they send out a generic email blast to everyone saying, upgrade your speed. It's inefficient. People just ignore it.
It's spam, basically.
It's spam. With Agent Workforce Cloud, an AI agent can segment the customer base down to what they call a segment of one.
A segment of one. Explain that.
The AI looks at a specific household's behavior on the network. It sees, okay, they're gamers or they work from home or they stream 4K video all night. Then the agent automatically buys highly targeted social media ads.
Oh, wow.
Yeah, like an ad on Instagram at 8 p.m. when that specific person is scrolling for maybe 5 cents. Instead of spending $10 on a useless blast campaign.
So it automates the kind of sophistication that usually only a giant corporation like a Verizon or a Comcast would have.
Exactly. It democratizes data science.
Yeah.
And Michael Weening, the CEO, is going all in on this. He is actually keynoting at Mobile World Congress in Barcelona.
MWC, that's a huge deal. That is the Super Bowl for telcos.
It is. And Calix has never really been a headline act there. But they are positioning themselves as an architect of AI. He's speaking right alongside the CEO of Qualcomm.
So they're trying to show the tier one giants, the AT&Ts and British telecoms of the world, that Calix isn't just a hardware vendor for rural America anymore.
You're an AI platform.
Yeah.
And that explains the Google partnership, too. Google wants to sell cloud services to those tier ones, and Calix becomes the application layer on top.
It's a symbiotic relationship.
It is. And there's one more layer to the Google move. It allows for private cloud instances.
And why does that matter?
Because a massive carrier, a Verizon or a Vodafone, they are never going to put their subscriber data on a shared public cloud with some tiny rural co-op. The security risk is just too high.
Right.
The new Google architecture allows Calix to spin up a dedicated private instance just for that massive client. It removes the biggest objection in the entire sales cycle.
So the cloud migration isn't just about costs. It's about unlocking the total addressable market of the biggest companies on the planet. Okay, let's talk about the money. Because while the market is freaking out about margins, the company seems to be putting its money where its mouth is on the stock price.
Oh, they are getting incredibly aggressive with buybacks. In Q4 alone, they spent $17 million buying back their own stock.
17 million. And that's a big jump from Q3, right?
It's a four-fold increase from what they spent in Q3.
So they saw the price in Q4, which was higher than it is today, and thought it was cheap. They must really love it down here at 47 bucks.
They clearly do. The board just authorized another $125 million for the repurchase plan, and they already had about $109 million left.
So they have over $230 million of dry powder to support the stock.
For a company with a market cap around $3 billion, that is nearly 8% of the entire company they can retire.
And they have the cash to do it.
Yeah, the balance sheet is a fortress. They ended the year with $388 million in cash and investments. Inventory turns are solid. Everything looks disciplined.
Financial discipline is great, but let's talk about external catalysts. We can't talk about Calix without talking about BEAD, the Broadband Equity, Access, and Deployment Program.
That's the massive government stimulus to build fiber everywhere, yeah.
We finally got some real numbers on this, didn't we?
We did. For a long time, it was just this vague tailwind. Now, management has sized the BEAD opportunity specifically for Calix at between $1 and $1.5 billion.
1 to 1.5 billion. That is massive. That's essentially doubling their annual revenue.
It is huge, but, and this is a big but, the timing is pushed out. They're seeing orders now, but the actual deliveries, and more importantly, the revenue recognition, that won't ramp meaningfully until later in 2026 and into 2027.
So it's really a 2027 story.
For the big numbers, yes, but it provides a floor. And there was a fascinating kind of physics argument on the call about the competition. You hear a lot about low Earth orbit satellites like Starlink.
Oh, I love a good physics fight. What'd they say?
They pointed out that 85% of the government funding went to fiber, and only 5% went to satellites. Their argument is pure physics and economics. Fiber has higher capacity and, crucially, lower operating costs over a multi-decade life cycle.
Explain the operating cost angle.
Well, if you put a satellite dish on a roof, the electronics degrade. You are rolling a truck out to replace that equipment every 5 to 7 years. If you put fiber in the ground, that glass lasts for 30 or 40 years.
You just upgrade the lasers at the ends.
That's it. So the total cost of ownership for fiber is way, way lower. They basically said satellite is only a solution for the extreme edge, the house on top of a mountain where you literally cannot run a cable.
For everything else, fiber wins. Makes sense why the government is biasing their funding that way. They want infrastructure that lasts.
Right. So let's zoom out to the investor context.
Yeah.
Management made a pretty bold claim that they have crossed the chasm.
Yes, the classic Jeffrey Moore concept.
They believe they have left the early adopter phase with their platform and have now entered a sustained growth phase. They reaffirmed a 10 to 15% revenue growth target for 2026.
And that's excluding the BEAD money.
That excludes BEAD. So you've got 10-15% organic growth plus a $1 billion kicker from the government coming down the pipe.
That's the thesis. And part of that growth is this tier one chase we touched on.
Right. They've dominated the smaller regional players. Now they want the big fish. But selling to a tier one is a nightmare, isn't it?
It's a totally different game. The sales cycles are, 18 to 24 months?
Yeah, you don't just walk in and sign a deal. But their strategy is clever. They're using that private cloud capability to get a foot in the door. And they're also clarifying their business model now.
How so?
They are now explicitly separating appliance revenue, the hardware boxes, from software and services. This is crucial for how you value the stock.
Because hardware is lumpy and software is recurring?
Exactly. They want a SaaS multiple, not a hardware multiple. They were very emphatic. We are not a services company. We are a platform company.
Which brings us back to the margins. They said software margins are depressed now because of the dual cloud, but long-term, they see them climbing past 70%.
That's the target. And if they hit that, the current valuation looks very, very different.
Okay, we have covered the good, the bad, and the ugly of the guidance. We've looked at the AI pivot and the government money. Now it is time for our favorite segment.
Uh-oh.
This is where we throw out the rule book and pitch a trade idea that is wild, aggressive, and might just work.
Okay, disclaimer time. This is absolutely not financial advice. We are two voices on a podcast, not your fiduciaries. Do your own diligence. This is for entertainment only.
Do not blame us if you lose your shirt. Okay, hit me. What's the play on Calix?
I call this trade the dual cloud dip arbitrage.
I like the sound of that. Break it down for me.
Okay, here's the setup. The market right now is basically a collection of algorithms. Those algorithms read guidance, margin compression, and they puked the stock. They see margins going from 58% down to 56%, and they short it.
It's just a knee-jerk reaction.
It's a total knee-jerk.
Right.
But the compression is artificial. It is literally just the cost of paying two landlords, Amazon and Google, while you move your furniture. It is not structural.
So you're saying the market is mispricing a temporary expense as a permanent decline in the business.
Correct. So the trade is you buy the whole right here at roughly $47. You're buying the fear.
Okay, and the catalyst to get you out of the hole.
The catalyst is Q2 or Q3 of this year. The moment they announce the migration is complete, the old cloud gets turned off. Boom.
Those duplicate costs vanish instantly.
Instantly. And margins snap right back to 60% plus. And suddenly the algos read margin expansion, and they buy it all back up.
And you have a second kicker.
The BEAD money, it starts printing on the appliance side later in the year. So you get margin expansion and revenue acceleration at the same time. That is a powerful cocktail for a stock.
And there's one more thing that makes this juicy.
The buyback.
Management just authorized $125 million in new buybacks. They spent $17 million last quarter when the stock was higher. You know the buyback desk is going to be feasting at these levels.
You're basically front-running the company's own treasury department. It's a margin expansion coil that is loaded for the second half of the year. You sit through the chop in Q1, and you ride the expansion in Q3.
It is audacious. It ignores all the short-term pain for the medium-term gain. I love it. But again, it's risky. If that migration gets delayed,
Or if the agentic AI stuff turns out to be vaporware.
then you are stuck in a value trap.
That is the risk. But the risk reward at these levels with that balance sheet, I think it's compelling.
All right, let's wrap this up. Recap for the people driving to work right now.
Calix delivered a record Q4 revenue, margins, cash flow, all hit highs. But they scared the market with expensive moving costs in their Q1 guidance due to a cloud platform migration.
The fundamentals, specifically RPO and cash, remain very strong. The stock is down significantly, creating a potential disconnect between the price and the actual value.
And the big bet for 2026 is this transition to the third-gen platform and agentic AI. Management believes this is their ticket to the big Tier 1 telcos.
And if you want to see if this story holds water, there's a date you need to circle on your calendar.
February 24th, they're hosting an Investor Day at the New York Stock Exchange. That is where we will get the deep dive on the AI strategy and hopefully more clarity on the exact timing of that BEAD revenue ramp.
So keep your eyes peeled for that. That wraps up this deep dive from Talk Tickers. Remember, the market can be irrational longer than you can remain solvent.
But the numbers usually win in the end.
Usually. Thanks for listening. We'll catch you on the next print.